This week saw the release of the June quarter national accounts update, hotly awaited update given the uncertainties around how the economy is travelling and inflation prospects for the year ahead. The results were slightly softer than expected and definitely a softer tone to the consumer, where consumer spending actually declined in the quarter and was slower in terms of annual growth, running at just 0.5%. More broadly speaking, though, it would have been in line with the RBA's expectation, and some of the improvements that we're seeing through productivity growth and so on would have been eased their concerns only slightly. Certainly the takeaway from the RBA Governor in a speech following the release suggests that they're still vigilant on the inflation outlook and we saw the update in general terms as the economy tracking in line with their expectations. In terms of the detail, it's really just net export performance, particularly our exports of foreign student education services and tourism services, plus a rising government spend domestically are the two things that are keeping things ticking over as far as the economy goes. Aggregate GDP rose 0.2% in the quarter, annual growth slowing to 1%, but within that the private components were quite weak. As I said, consumer spending declined 0.2% in the quarter. That follows an extended period of softness. We now have 6 quarters in a row where per capita consumer spending has declined. That's the longest run of weakness of per capita declines that we've seen since quarterly estimates became available in 1959. So, the consumer squeeze is still happening, not much relief around there. When we look at the income components for the consumer as well, they're a bit on the disappointing side. Basically, disposable incomes only just keeping pace with inflation and only growing 0.4% over the year as well. So the consumer space was definitely soft, and that looks to be spilling over somewhat into the private business activity space as well. Business investment was about flat. Housing construction was also flat. As I said, the one thing keeping things ticking over domestically is around government spending and activity. In fact, government consumption as a share of GDP rose to a new cycle high this quarter. Without that, we would have seen the wider economy move into an outright contraction. Of course, going into this data, there's a little bit backward looking. It predates the July 1 tax cuts, and the RBA Governor reiterated they will be watching very closely to see how much or if a recovery in consumer spending starts to form as those tax cuts flow. We've mentioned previously our Westpac card data suggests there's been a pretty muted response to those reduced taxes so far. We have data up to through to August now, but they'll be monitoring the wider picture of data going ahead, and of course they'll be very interested in the inflation updates that we get, particularly the September quarter update, which will be out in late November. The other aspect of this release that was of interest for the RBA was the updated estimates around productivity growth and unit labour costs. And on this front, it was probably not quite as positive as the RBA might have been expected. Positive in the sense that it's pointing to more subdued inflationary pressures. We are seeing things turn. Unit labour costs is really the one that we're focusing on there. On a 6-month annualised basis, unit labour cost growth is now tracking about 3.4%, so that's helpful. It's come down from its peaks and it will be giving the RBA some comfort, but I think the messaging is still pretty clear that they will need to see much more evidence that inflation is going to be comfortably back within their target band in a reasonable time frame, and on that front it's really the quarterly CPI updates which will be of most interest. So looking forward, the next port of call for the RBA will be that update around Q3 CPI inflation, and of course we'll be watching the consumer space very closely from here, given we're now on a slightly weaker trajectory going into the second half of the year.
The content of this recording is informational and of general nature only, and is not intended to constitute a research report or reflect any recommendation or financial advice. It has been prepared without taking into account your objectives, financial situation, or needs, and investment decisions should not be based on it. You should obtain your own independent advice before proceeding with any investment decision. Whilst every effort has been taken to ensure that the contents are correct and any opinions, forecasts, conclusions are reasonably held based on information at the date of recording, Westpac does not make any representation or warranty as to the accuracy or completeness of the statements or information contained in this recording, and any liability therefore is expressly disclaimed to the extent permitted by law. None of the material included in this recording should be copied, published or reproduced in whole or in part without the prior written permission of Westpac.